Today, we're diving into candle range theory, an advanced trading concept that can supercharge your win rates. By mastering CRT, you'll learn how to predict price movements and candle formations with precision, putting you in sync with institutional traders rather than being caught on the wrong side of their moves. In this video, we're going to cover some key concepts that will help you fully understand and master candle range theory. Here's what we'll dive into. What is candle range theory? The power of three, how accumulation, manipulation, and distribution work in the markets. How smart money uses the power of three to trap retail traders. How to predict smart money moves before they happen using CRT. Candle range theory pattern types. Time frame breakdown for CRT execution. Key times for high probability CRT setups. Practical examples of trading high probability CRT setups. So stick around. By the end of this video, you'll have a powerful tool in your trading arsenal. Candle range theory is built on a simple yet profound idea. Every candlestick on a chart reflects a range of price action. When viewed from a higher time frame, this candle represents the broader market's movements, and when zoomed into a lower time frame, you'll notice the micro movements forming within that range. Here's what you need to know. Every candle has a high and a low. These points form a price range. As you zoom into a lower time frame, this range becomes clearer and forms the basis of the CRT strategy. In markets, price moves through three main phases: accumulation, manipulation, and distribution, or what we call the power of three. These phases represent the cycle the market constantly moves through. Accumulation, this phase is where price consolidates and moves sideways, gathering liquidity. Manipulation, here, the market pushes price beyond key levels to trigger stop losses, grabbing liquidity. Distribution, after manipulation, price reverses and moves in the opposite direction to distribute liquidity. The power of three is essentially the heartbeat of the market. Understanding these phases is crucial for applying CRT effectively to spot high probability trades. How smart money uses the three market phases to trap retail traders. Let's start with the accumulation phase. In this phase, smart money begins to build their positions while keeping the market relatively flat. You'll often see this as consolidation or sideways movement on the chart. The price stays contained within a defined range, and it looks like nothing major is happening. When we zoom out to the higher time frames, such as the daily or 4-hour chart, this accumulation phase often shows up as a narrow range candle, or a series of small candles moving sideways. The purpose of this phase is simple. Smart money is preparing for the next stage, the manipulation phase. They are quietly accumulating long or short positions, all without triggering large price movements. Now, let's move on to the manipulation phase. This is where smart money grabs liquidity by triggering stop losses. They deliberately push the price below support or above resistance, causing retail traders to exit their positions or enter new ones, thinking the market is breaking out. When we observe this phase on higher time frames, such as the daily or 4-hour chart, we'll often notice long wicks or shadows extending below the candle's low in a bullish setup, or above the candle's high in a bearish setup. These wicks represent the market manipulation where smart money collects liquidity. This is where candle range theory, or CRT, becomes especially useful. CRT helps us spot this manipulation by observing these sharp movements on higher time frames. For example, if you see a long wick below a support level on the daily chart, it's a sign that the price was deliberately pushed down to trick traders into thinking a breakdown was happening. Once the liquidity grab is complete, the price usually reverses, marking the start of a bullish move. Now let's discuss the distribution phase. After the price has moved up or down following the manipulation phase, smart money starts offloading their positions. They do this while setting up another liquidity trap, this time at the resistance level in a bullish setup. Retail traders are often lured into buying at the top, thinking the price will continue rising, but instead, the price reverses sharply. On higher time frames, such as the daily or 4-hour chart, we typically see a long wick above resistance in a bullish trend. This wick indicates that smart money is offloading their positions while trapping traders again. The sharp reversal that follows confirms the distribution phase. Candle range theory, or CRT, helps us recognize this setup by focusing on price action near the high of the candle range. If the price wicks above the high and then reverses, it's a clear sign that smart money is distributing their positions. Let me give you a practical example to understand how you can predict smart money behavior before they even act. Look at this candle on the hourly time frame with a defined high and low. The price briefly drops below the low and forms a lower wick before closing back inside the range. This